I'm Stephen Halasnik. Over the last 25 years, I've been lucky enough to build 6 companies. Those companies have been between $5 and $25 million in revenue. And during those 25 years, I've had to interact with banks a lot to get approved for my own lines of credit or term loans. And so, as good as many of you might be at running your business, if you haven't applied to a bank for either a line of credit or term loan, you're in for a new learning experience, just putting it nicely. But what I want to do with you today is kind of share with you what I've learned and what banks are going to be looking for and what you should be prepared for. The first thing you should know is that when it comes to the economy, that has a huge effect as to if a bank is going to be strict in regards to what it's looking for or less strict. And what I mean by that is in a good economy, the underwriters for the bank are going to be a little bit more lenient. They might ask for less collateral. We're going to get to what that means in a second. Or in a bad economy, they might ask for a ton more collateral. Now, what collateral is and what every bank looks for is collateral, which is assets to back up the loan. Now, it could be a personal asset. It could be a business asset. Now, personal assets could be equity in your house, could be stocks, bonds, other things that are readily sellable that the bank would see value in and will give you a percentage of that. In a business, it could be inventory, it could be maybe you own commercial real estate, it could also be a percentage of your accounts receivable. But anytime you get any type of line of credit or any type of business loan, a bank's going to want to see some type of collateral to back it up. Unless you're over maybe $10 million or $20 million in size, then a bank might look a little closer at your cash flow and your income statement, your balance sheets and those type of things. But in general, for small businesses, if you don't have collateral, it's going to be tough to get a loan or a line of credit. Now, as far as personal guarantees, every single bank out there is going to want a personal guarantee of the owner or owners unless you have a very, very large company. And when I say very, very large, I mean anything over 10, 15, 20 million dollars a bank might consider. Even then, that's kind of considered small by banking standards. They're still going to want a personal guarantee. And what that means that if you default on the loan, any of your personal assets could then be pledged, or the bank will have a lien on them, and they would have access to those in case you default. Now, keep in mind that if you own your home with your significant other, with your wife or with your husband or somebody else, they also are going to have to sign for the business loan because they're going to be you're going to be pledging the equity in your house or your home as personal collateral. Sometimes that gets into a sticky situation. A lot of times, significant others don't exactly understand personal guarantees, so that sometimes can cause some friction. And the other thing that could be a problem too is if your business partner has credit problems. If you have a business partner and he's got a lot of credit problems, that could be a serious issue when it comes to being approved. Now, banks in general, depending on the economy, at least the lowest they're going to look for is a 680 personal credit score. But as the economy changes, it's always better to have a much better credit score. Anything over 700 is kind of considered a good credit score. Anything over 800 is like a really great credit score. The biggest problem that business owners have with credit scores is that when you're starting your business for quite a long time, you are signing for a lot of things personally. So when you get a credit card, even if it says your business name on it, it really is still backed up by you personally, and it shows up in your personal credit report, and that has a big effect on how high and low your credit is. And a lot of times that just really causes some problems, regardless if you pay your bills all the time. I mean, for the longest time, I really didn't pay attention to my personal credit score. It wasn't really in vogue a number of years ago, and when I did finally look at it, I saw that so many things that I had on the business were being reported on my credit report because I had personally signed for it. And that causes your credit report to go down, regardless if you pay it all the time, because I always paid my bills. Back then I might have had a 650 credit score. Now I have over 800 credit score. But credit score has a big impact if a bank's going to want to approve you or not. Again, they're going to want to see at least 680. And again, this could be a problem if you have a business partner who has a bad credit score. The next thing that the banks are going to look at too is the industry you're in. And there are certain industries that banks do not like cash-based businesses. They also don't like certain businesses that are kind of in the fringe of not being ethical, mainstream, a variety of different types of businesses. So if you're in an industry that banks don't like, they might say, that's not where we're going to be able to help you in. Now, the next thing they're going to ask for is, after you fill out a really lengthy application, the application will literally take you a week of solid working on it, depending on how much assets you have. But it does take you about 40 hours to fill out the application. You have to get a lot of information in. Once you submit it, the bank's going to ask for what's called an income statement and a balance sheet. And you really should make sure that your accountant looks over your income statement and balance sheet, because there are many times that things might have been categorized differently that the bank will not like. And the way that a bank looks at your business is very different than the way that you look at it. And the income statement and balance sheet is a big part of that. The other thing that you should know about something is, this is kind of later down the road, but if you get approved for the line of credit or for a term loan, you're going to have certain covenants in your terms and conditions for your loan. And in those covenants, which every bank will have, will say there are certain performance requirements that you are required to do, or the bank can pull your line of credit. Like an example would be, you may not be able to get a certain amount of debt. You may have to achieve a certain amount of revenue or a certain amount of profit. And the bank's going to look at that. And if they see that has changed, they can cancel your line of credit. The last thing that you're going to be a little bit surprised with is how expensive it is to get a line of credit or a term loan. There are a lot of upfront points, just like there are mortgages. There's a lot of administrative fees and a lot of appraisal fees or other things that are come about that a bank might want or they're going to have. So you're going to have extra fees. So there were times when I had a line of credit with a bank that I never touched, but yet I still had to pay about $1,500 a year just to keep it in place, which was, depending on the size of the business, a little silly. But it's always a good idea to have a line of credit. I mean, one of the main reasons why I always had a line of credit in place was because I just, one time in my life, got caught up short on payroll and I had to borrow money from a friend. Now, what you all, probably may or may not know is, ever since I've been interacting with banks over all those years, it was good experience because I started my own company in 2002, which 2012, called Financing Solutions, which provides unsecured business lines of credit to both businesses, small businesses, and nonprofits. And the good thing about that, our line of credit, is it's really different than a bank line of credit. It doesn't cost anything to get the line of credit. It doesn't cost anything if it's not being used. And the only time you are charged is when you are using the line. And typically it's solving a major problem that you have. You're short on making payroll, just like I had the problem once, and you use, a percentage of it to make payroll, then you pay the line back when you're ready. Our line of credit in most cases is a little bit more expensive than a bank line of credit. And if you can be approved for a bank line of credit, it's certainly the way to go as long as you're going to be using it. But if not, our line of credit is a good alternative. And the link to our company will be in the notes for the YouTube section on the bottom. So anyway, hopefully that helps you learn a little bit more about what banks will be looking for, and I hope you have a great day.